Welcome back to The Explainer. So today we're tackling a really interesting one, GrafTech's Q2 earnings. On the surface, it looked like a bit of a mess, but the market, well, the market went wild. Let's figure out why.
So get this, on July 25th, GrafTech comes out and reports earnings. And they miss, not by a little, but by a whopping 33% on adjusted EPS. So what do you think the stock did? Tanked, right? Nope. It rallied hard, over 14% by the end of the day. And that's what we're going to unpack right now.
This is the big question, isn't it? What on earth did the market see? There had to be something buried deep in that report, something that completely overshadowed the headline earnings miss. What was it? All right, let's start at the beginning. We've got to look at the headline numbers, the ones that caused all the head scratching in the first place. And really, it's a classic mixed bag. Okay, so here's the scorecard. The bottom line, adjusted EPS. That was a clear miss. They reported a loss of 16 cents a share when the street was looking for a 12-cent loss. But then you look at the top line, revenue, and hey, a slight beat. They brought in just a little more money than expected. See, this is what we mean by a mixed report.
But here's where things get interesting. Forget the top and bottom lines for a second. The number that really mattered, the one that investors latched onto, was this: 28.6 thousand metric tons. That was their sales volume for the quarter. And trust me, this is the key to the whole story.
And that number wasn't just good. It was fantastic. We're talking about their highest sales volume in nearly 3 years, 11 quarters to be exact. Now think about this. In a market that's been pretty much flat, for them to post a number like this, it screams one thing. They are taking market share from their competitors.
But of course, there's always a catch, right? For as great as that volume growth was, up 12% year over year, the price they were getting for their product was down. You guessed it, by almost exactly 12%. It's like taking one big step forward and one big step back. And this dynamic, this is the storm that management is navigating. It's the core of the whole story. And this is why the market went nuts. Investors are smart. They looked at that price decline and said, okay, that's a market-wide problem. But then they looked at what management was doing about it, how they were executing, focusing on what they could control, and they loved what they saw.
The CEO, Tim Flanagan, he put it perfectly on the earnings call. He basically said, we're not just chasing volume for the sake of volume. This isn't about selling as much as possible no matter the cost. It's about being disciplined, about focusing on value. It's about selling smarter, not just harder.
And you want to see that strategy in action? Look at this. Total volume growth was a respectable 12%. But check out what they did in the U.S. market, a massive 38% jump. And why does that matter? Because the U.S. is their most profitable market. They were surgically targeting the high-margin business. And that move wasn't just for show. It had a real tangible impact. By shifting their focus to the U.S., they actually boosted their average selling price by about $80 per metric ton. So while the overall market was pushing prices down, their strategy was actively pushing them back up. That is exactly the kind of smart, proactive management that gets Wall Street excited.
And it didn't stop there. They also crushed it on the cost side. They managed to cut their cash cost per ton by 13% in the quarter. That's huge. And they felt so good about it, they actually raised their guidance for cost savings for the rest of the year. This is management proving they can execute, that they have a firm grip on the parts of the business they can control.
Okay, so that's the story of the quarter. But let's zoom out now and look at the bigger picture, because there are some really powerful long-term trends that are starting to work in their favor.
So the foundation for their business, the real bedrock, is this global push to decarbonize. Steelmaking is a dirty business, but there's a cleaner way to do it, the electric arc furnace, or EAF method, and that method is taking over. It's already more than half of all steel production outside of China. And here's the kicker. Every single one of those EAF mills needs graphite electrodes, the exact thing GrafTech makes.
But wait, there's more. Beyond the steel industry, a whole new potential catalyst is starting to emerge, and it has everything to do with the electric vehicle revolution. We're talking about graphite anode material. It's absolutely essential for EV batteries. And there's a huge push right now to stop relying on China and build a supply chain right here at home.
And this isn't just talk. The US government just made a move that could be an absolute game changer. They've slapped what amounts to a 160% tariff on the graphite anode material coming from China. You know what that does? It basically builds a protective wall around the US market, giving domestic producers a massive incentive to get in the game.
Okay, so let's put it all together. What does this mean going forward? It's time for our next call segment, where we give you our take on the investment thesis for GrafTech.
So we're calling our thesis the Green Energy Arc Bet. It's pretty simple, really. It's a bet on two massive parallel trends that we think the market just isn't fully appreciating yet.
Here's the thinking. You've got this dual-engine growth story. On one hand, you have the steady, accelerating adoption of EAF steel. That's their bread and butter. But on the other hand, you have this huge new opportunity in battery anodes, happening in a domestic market that's now protected by those massive tariffs. And what makes GrafTech so special here? They're vertically integrated. They make their own needle coke, which is the super high-quality raw material you need for both steel electrodes and EV battery anodes. It puts them in a really unique position. Oh, and that recent reverse stock split, that just cleans things up and makes the stock more palatable for the big institutional investors to start buying.
So, what's our official call? Look, for next quarter, we're expecting them to keep gaining market share. Pricing is still going to be the wild card, so we're watching that closely. The stock will probably bounce around a bit, but we think their solid operational performance puts a nice floor under the price. So, given that momentum and the strategic wins, we are initiating coverage with an outperform rating.
And of course, just a reminder for everyone, this is for informational purposes only. It is not financial advice.